Hey there, Casey Denman here from TaxSaleAcademy.com. In this video, we'll be talking about the difference between the tax assessed value and the fair market value. Too often, new investors look at the tax assessed value as an easy way to place a value on a parcel of real estate. Unfortunately, this can be very misleading, which is why we're shooting a video to discuss this exact topic. We'll be discussing both the tax assessed value and the fair market value. First off, let's start with the easy one. The fair market value. The fair market value is the value of a parcel of real estate that would be fair for a seller to sell it at and fair for a buyer to buy it at. It's the actual value of a piece of property as determined by the open market. That's pretty simple. Now let's talk about the tax assessed value. The tax assessed value, it's not quite as easy. The tax assessed value is the value that is assigned to the property by the tax collector in the county that the property is located in. And it is what your tax bill will be based around. Now, depending on the area, the correlation between your tax assessment and the fair market value can really vary significantly. Now, some counties will determine the fair market value first and then use a percentage of that figure, such as 70% or 80%, which will be your tax assessed value and is what your taxes will be calculated from. In other counties, they'll have an assessed value that is actually pretty accurate and pretty close to your fair market value. In other states, such as Michigan, the assessed value, or SEV as they call it, is only 50% of your fair market value, which can really turn your numbers upside down if you're only using the assessed value for your valuations. Now, something else to consider is when the assessment was performed. Maybe your numbers are accurate. Maybe the fair market value is equal to the assessed value. Well, guess what? If the property was assessed and those numbers are 2 or 3 years old, they won't be relevant anymore. Even if they were from less than a year ago. What if something has happened to that property since then? Like a building that has burned down, for example. Those will certainly mess up your assessments. As you can see, it can become incredibly confusing and misleading when you use the tax assessed value as your sole basis for an investment. Sure, tax collector reports can provide a wealth of information to us as tax sale investors, but we must remember that it's just one of the tools that you need to use for your tax sale research. It's not the only tool. To learn more about valuing real estate or how to profit from tax defaulted real estate, head on over to TaxSaleAcademy.com. Again, the website is TaxSaleAcademy.com. Have a wonderful day, folks. Take care. Bye-bye.